Welcome to episode 1 of our goal-based investing series. In our introduction, we analyzed Rahul, a Bangalore-based IT professional. Since 2023, Rahul has deployed 12,000 rupees every month into standard SIP. By April 2026, he has invested a total of 4.32 lakhs. However, his portfolio today sits at just 4.3 lakhs. So this is not just a bad patch. We are currently in a sideways volatile market where the Nifty has struggled to break past structural resistance. And add to this the weakening of the rupee against the dollar, which has increased our import cost and pressured corporate margins. So when you factor in 6% inflation and the 10% tax on gains, Rahul's real wealth is actually shrinking. While the mainstream media tells you SIP hai to sahi hai, the data shows that the safe model is failing in this environment. And this brings us to the core of today's story, the SIP trap. We chose to start with SIPs because they are the foundation of most Indian portfolios. But in 2026, this foundation is cracked. Our data led us to call the IT sector peak in December and the banking recovery in March. We tracked the capital flows that the retail crowds might miss. If you prefer data over hype, subscribe and join our community of methodical investors. It's our 9-to-5 job to deconstruct noise, and today we will try and understand why the Indian SIP story of automatic wealth creator has hit a wall. To understand why your returns are flat, we must deconstruct the mechanics of the liquidity trap currently paralyzing the Indian secondary market. In 2026, we are witnessing a massive structural exit. FIIs have offloaded over 1.6 lakh crores in this year alone. This is not a panic sell, it's a strategic reallocation. Global funds are moving out of India, driven by high domestic valuations. So here is the anomaly. DIIs are absorbing this massive selling pressures using your SIP inflows. When your bank account is debited on the 5th or 10th of every month, the capital is not necessarily buying growth or future earnings. It is providing the exit liquidity that the FIIs need to leave the Indian market at elevated prices. And this creates what we call a valuation ceiling. Your SIP is effectively subsidizing the exit of smart money. In 2026, you are not buying the dip. You are catching a falling knife that is being held up by retail sentiment alone. This is the mechanical reason why, despite your consistency, the portfolio value remains trapped. The second failure point is the single bucket mandate. Most Indian mutual funds are bound by strict tracking error constraints. Even if a fund manager sees that the systemic risk in the IT or banking sectors, they cannot move to cash or hedge effectively without violating benchmark mandate. In 2026, the Indian IT sector is facing a significant non-cyclical disruption due to LLM-driven automation. Yet, because IT remains a heavyweight in Nifty 50 and most large-cap indices, your diversified SIPs continued to pump capital into a sector facing a structural capex contraction. Rupee Cost Averaging only works if the asset eventually breaks out to new highs. In a sideways volatile market, which characterizes the 2024, 2025 and 2026 period, you are simply averaging into mediocrity. The back-tested data shows that the cost of your units is hovering dangerously close to the realization value. And we call this the yield trap. You are taking 100% of the equity risk for returns that are currently underperforming a standard liquid fund or even a tax-free bond. So returning back to our Bangalore case study, Rahul's portfolio is a mirror of the broader market stagnation. He is not failing because of a lack of discipline. He is failing because his strategy assumes a 2010s bull market logic in a 2026 macro regime. Reliance on a single bucket, unhedged equity SIP is no longer a strategy, it is an oversight. And unfortunately, this is the bitter pill about SIPs that none of us, I think, is willing to swallow. In our next episode, we will analyze the second order effects of this stagnation. Why the rush into F&O and direct equities has become a high stress trap for the Indian professionals. If you prefer data over hype, subscribe and join our community. Thank you for tuning in and thank you for your time, and I'll see you in the episode 2.